All right, Louann.
Here I am. How does it
All
sound?
right, that sounds better.
Great. You know what? I hate to say it sounded okay, I think, when there were just the two of us. I don't know if it's the adding other people that's a problem.
Well, I guess we're going to see in a second.
I think we will. Oh,
So we are waiting on Robert to show back up. All right. Hey, Robert, how are you? Hit your mute button.
Okay, hello.
All right, all right. Well, I think it's you, Robert.
Sorry about that.
Louann, you speak for a second.
can you hear me okay?
Yeah, I think it's when, it could be when we bring other people on.
I think so, but the feedback is back.
All right. We probably have to put everybody on mute, and as I give the introductions, we may have to speak in that manner.
Okay, I'm muted.
All right. Let's just get them on in and let's start talking. Good morning, everyone, and thank you so much for joining us on a call today. Sorry that it has taken us a little bit longer than usual to get started, but we had a little bit of technical difficulties. And hopefully these things are going to work itself out for us, right? Once again, I want to say thank you very much for deciding to join us this morning. My name is Travis Stegall. I am the Community and Economic Development Director for the City of Brunswick, and it's our job here to kind of make sure that we were able to help all business owners, not only just in Brunswick, but business owners in the region to wade through a ton of information that's been coming down from the federal government, SBA, USDA, and other platforms. And we are hoping that today's meeting will get quite a few questions answered. The second thing, we really do hope that this will also give you a little bit of ease in figuring out, should you apply for any of the things that we talk about, and how to apply for some of the things that we're talking about. And first of all, before we get started, I would like to take a little bit of time out and thank some of our partners that were instrumental in getting some of this information out and having you guys to join us today. And that was the Golden Hours Development Authority, our partners over at UGA Small Business Development Centers, and also the Chamber and the Downtown Development Authority. All of these guys are playing a very integral role in us being able to provide the resources and partnerships and relevant information that we're able to give you guys going forward. We know that this COVID-19 thing has been a shocker for a lot of businesses and a lot of individuals. And so we're hoping today to be able to partner with a really great group of attorneys that have been my sounding board now for the last couple of years. It all started with the Opportunity Zone. And the depth of knowledge that we have within the region is second to none, right? It's totally second to none. And just to give you guys a rundown, the things that we talk about today, don't worry about it. We really wanted you to kind of listen in. We're going to have charts and contact numbers and things of that nature. For those of you that logged in, we have been able to get your information as you log in, and we are going to be able to send you the information from charts and screenshots and best practices on the way that we get these things done. Also, you will have a way to contact what individuals also. So we can get started. I want to first introduce Louann Bronstein. She's a partner with HunterMaclean, where she leads the corporate and tax group. She has a broad corporate law practice with a sub-practice focusing on mergers, acquisitions, and funding. She represents numerous manufacturers and service companies from a broad range of industries. She routinely advises CEOs, CFOs, and other senior executives, board members, and owners for business formation. She also enjoys partnering with clients as outside general counsel and working closely with them on issues central to the success of their business enterprises. Why did I make this introduction? Is literally to let you know the type of talent we have on the phone. Second, I am going to introduce Rob. So Rob McGuirk is also another partner with HunterMaclean and the chair of the taxation practice group. Rob is a tax professional with over 25 years of experience. He was a member of the international tax group at PricewaterhouseCoopers and later served as a chief tax executive. Before joining HunterMaclean, Rob served 11 years as an executive director of tax and tax counsel for Quest Diagnostic. If you don't know, that company is a Fortune 500 company. He specializes in international, federal, state tax planning. His particular expertise is in transactions involving mergers, acquisitions, and dispositions. So once again, we have very knowledgeable, high rate talent who's going to be speaking with us and kind of going over the things that we are trying to get done as far as helping you guys wade through, like I said, the things that have come down in the CARE Act. And with that said, Louann and Rob, if you can take yourselves off of mute and let you introduce yourselves also. Louann, you go first.
Travis, thank you for the introduction. I'm pleased to be on the call today and look forward to giving some information this morning.
Awesome.
I would echo Louann's comments. I'm pleased to be on the call today, and hopefully we convey some helpful, useful information for businesses in the area.
Perfect. So for the sake of time, we're going to go ahead and hop into the question and answering session. Louann, if you do not mind, could you give us a brief synopsis of what the Payment Protection Program is and the Economic Disaster Loan, Injury Loan?
Sure, and I will split this with Rob. I think maybe and as you mentioned, we have a chart that has a side-by-side comparison, but it may make more sense to run down one type of loan and then the other. So I'm going to start with probably what is on top of everyone's mind, and that is the payroll protection loan. It's sometimes called the payroll protection program, so I'll make it easy and just call it the PPP. That is part of the CARES Act that was enacted on March 27th. And really, it's an overlay to the existing SBA's 7A program. And it's an overlay that covers the period, it looks back, but covers the period from February 15th, 2020 to June 30, 2020. But I think the key thing is, and what everybody has been asking is, there's, in essence, a new type of loan. When can we apply for it and how? And the when is, you can apply for the loan starting tomorrow, April 3rd. And this loan, because it is an overlay to the existing 7A program, the loan will be made through existing SBA lenders, and it will be broadened to cover other financial institutions. But the easy way to think of it is, if you already have a 7A lender or you have a relationship with a bank, which I think probably most of you do, probably step one is contact your bank. The other part is the application is already online, and we can publish a link to that too, but it's a 2-page application. It's a fillable PDF. It's very straightforward, and Rob will talk later about how you calculate the dollar amount that needs to be put on the form. And there will be some supporting documentation required. I should also say this is a very quickly evolving area. For example, yesterday, SBA lenders that were emailing me, candidly admit they know that applications will open up banks to receive them tomorrow, but they don't know yet what documents will be required, whether the application can be done online, which would make a lot of sense. We're trying to social distance. We don't know about bank staff, so you can probably expect to stay tuned today for more information on what you do with the application.
So I have a question about the application.
Sure.
So with this 2-page application, with the banks not truly understanding or knowing the additional information that's going to come in, should we just go ahead and apply, still fill out the application and have it ready?
Yes.
To take it to our bankers?
Yes, have the application ready, and I can circulate later today if it's not already out there. There are various lists. Some banks have a list of like 5 things that you might expect, like evidence of 2019 payroll, and others have other things that they've added to it, like 2019 taxes or 2018 taxes if you haven't filed 2019. But you could probably expect to go ahead and get together 6 to 8 backup documents. But I may be getting ahead of myself in the eagerness of trying to address how you can apply, and step back and address who can apply and why you should apply. And who can apply, I can't see who's on the call, but my guess is probably everybody who this program is of interest to can apply. It's if you have less than, and these are rules of broad rules of thumb, if you have less than 500 employees, yes, you certainly are within the size requirements. It's higher in some cases for hospitality, but basically if you have 500 employees or less, you can apply.
Can I apply if I'm a 1099 contractor?
Yes, but the application process for individuals and independent contractors opens up on April 10th. So what we normally think of as small businesses, your Incs., your LLCs, that process opens for them tomorrow.
Okay, so small businesses that currently have employees that are less than 500 need to start to apply tomorrow,
Right.
Which is April the 3rd.
Yes.
Independent contractors, 1099 contractors, need to start applying April the 10th.
Yes, they cannot apply before that.
Gotcha.
And then why should you apply? And Rob will get into the loan forgiveness and how that's calculated. But probably the question is, why not go ahead and apply? Because here are some things that are different. Unlike normal SBA 7A loans, there's no application fee, no type of processing fees. It's completely fee-free to apply. All it takes is your time to fill out the application, submit it somehow, either in person or online if that's possible, and gather up the documents. And looking at the application, I would say it would literally take, to key in the info, 10 minutes. I mean, you have to do some background work that Rob will get to. There's no personal guarantee. There's no collateral required. So in essence, you can, if you get it and can prepay it, if it's not forgiven, there's no prepayment fee. If you get it and it's not forgiven, the interest rate is really low, 0.5%. You don't have to prove that you have credit available from another non-government source, which is normally the case.
Okay.
And the term of any portion that's not forgiven is 2 years. So I think at that, I can either take questions or turn it over for some of the more details on how things are calculated to Rob.
So I have 2 questions, and before you hop on, Rob, is there anything that's out there for 501 nonprofit that are designated C6s? We have some great nonprofits here that employ quite a bit of people, and we also have nonprofits that are here that are business-oriented nonprofit that takes memberships. That so if you are 501 C6.
They are within the world of who can apply, nonprofits. And as you've already mentioned, sole proprietors, self-employed people, independent contractors, as long as they're less than 500 employees.
Okay, perfect. And how about local government agencies? That was a question that came up. Are local government agencies able to find a way within these 2 programs?
I may have to punt that one to Rob or get back to you because and part of this, part of the research is for our clients, and I don't have any government agency clients, so that question has not come up for me before.
Okay, all right, thank you. So Rob, if you can do us a favor and get into our qualifications. How do we apply for this thing? And if you could explain the 25-75 breakdown in use.
Yes, okay, so the first question is, what is the loan amount that you can obtain under the program? And generally speaking, it equals 2.5 times your average monthly payroll for 2019. So essentially 10 weeks of your average monthly payroll for 2019. In terms of the potential forgiveness of that amount, in order for the amount to be forgiven, you have to use the loan amount within 8 weeks of receiving the loan. And you have to use it on allowable purposes. The allowable purposes include payroll costs, and they define that term, rent, utilities, and interest on mortgages. Regarding the definition of payroll costs, it includes salary, wages, health benefits for self-employed people, net earnings from self-employment. But it excludes any payroll to any individual to the extent it exceeds approximately $13,000 in the 8-week period. Because if you annualize that, that would be about $100,000. So any amounts above that to any individuals is not a qualified purpose. So if you spend the loan proceeds within the 8 weeks after the loan on those permitted purposes, that amount is potentially forgivable. Now, one of the things that we noted yesterday in the loan application that was published was they asked you, the borrower, to certify that you intend to spend 75% or more on payroll costs. That is to say, no more than 25% on those other allowable things, utilities, rent, interest on mortgage. Now, that's not required under the statute, but in the application form, they are asking you to certify that. And they sort of indicate that the reason why they're asking that is that there's $349 billion allotted under this program. And there might be some fear that the demand may exceed that. And perhaps in granting the loans, they might give preference perhaps to people or businesses who indicate that they intend to use 75% or more for payroll costs. So that's...
So Robert, we have a question for you. So there's possibly going to be some sort of, I guess, tier lending. If you're borrowing money and a majority of the money, up to 75%, is going to be used to pay payroll, you may have a higher than usual opportunity to get that loan amount that you're looking for. Is that how we can perceive that?
Yeah. We don't exactly know, but by them asking that question, we might infer that to be the case.
Got it.
So that's the amount of the loan that's potentially forgivable. So if you don't spend it within the 8 weeks, the loan will not be forgiven. And as Louann said, it will carry interest at a low rate, 0.5% with a 2-year maturity. If you also spend the money on non-permissible purposes during the 8 weeks, the loan also won't be forgiven. I mentioned it's potentially forgivable. And the reason I said that is because they then potentially reduce the amount of the loan that can get forgiven based on the application of 2 different tests. One test is looking at the average monthly full-time equivalent employees during the 8 weeks after the loan and comparing that to the average full-time equivalent employees during a base period. Now, the employer or the business can elect 2 different base periods. It will want to elect a base period that results in the lower full-time equivalent employees. The 2 different base periods that can be elected are January 1, 2020 to February 29, 2020, or February 15, 2019 to June 30, 2019. So let me give you an example of how this reduction in the amount that could get canceled might work. Let's say during the 8 weeks after the loan, your average monthly full-time equivalent employees are 8. But during the base period, your monthly average full-time equivalent employees are 10. Well, in that case, the amount of the loan that potentially will be forgiven will be reduced by 20%. So for example, if you obtain a loan of $10,000 and you use the loan for permissible purposes in 8 weeks, only $8,000 after the application of this test will be forgiven based on this full-time equivalent reduction test. Now, there's one thing to keep in mind about this test. To the extent that you've eliminated a position or reduced out February 15, 2020 and April 26, 2020, if you restore them, to the extent you restore all of those positions or all of the reduced hours by June 30th, then you will be treated, you will not be penalized for having reduced positions or reduced hours by reason of application of this test.
Sorry. Yeah, sorry, I have my phone on mute. So does that mean that if we had to lay off someone in a business, do we have to bring that person back, or do we have to fill that position within the 8 weeks?
That's a great question. And the way we read the statute, and obviously we would hope for guidance on this, is that you just need to restore the eliminated position or restore the hours that were reduced. Obviously, in the span of time, people may move on and you may not be able to rehire that particular person. But if you restore the same position at the same pay by June 30th, we think that qualifies.
So if we restore that position, restore the hours within the 8 weeks of getting the loan, now we qualify for that forgiveness.
So it's 8 weeks, it's by June 30th. So you may have
By June 30th, okay.
Okay, June 30th. So maybe after the 8 weeks, but before June 30th.
Okay,
now,
so June 30th.
There is an outstanding question about this mitigation provision, which is if you do eliminate positions and reduce hours, do you have to restore all the positions and all the reduced hours by June 30th to take advantage of the mitigation provision? Or if you restore some of the positions and reduce hours, would you at least benefit from the mitigation provision to the extent you restore some positions and restore some hours? We don't know the answer to that question. The statute as written seems to suggest you have to restore all the positions and all the reduced hours.
All right, so can businesses apply for both payroll protection and the economic disaster injury loan?
That's a great question. And that's a question that has come up quite a bit. We haven't talked about what is the economic injury disaster loan and how it contrasts. And we should do that. Before I get to that question, though, I mentioned that there's 2 possible reductions in the loan forgiveness amount. The other possible reduction is based upon looking at the salary and wages that you paid to the employees who continue to work for you during the 8 weeks with the salary and wages that you paid to them essentially in the first quarter of 2020. And to the extent for any individual employee who is working for you during 8 weeks, the aggregate pay in the 8 weeks is less than 75% of what you paid them in the first quarter of 2020, that could result in a dollar reduction. So for example, if you pay an employee $600 in the 8 weeks following the loan, but you had paid them $1,000 in the first quarter of 2020, well, $600 is $150 less than 75% of the $1,000 that you paid them in the first quarter. So you may have a reduction in the loan forgiveness amount by that deficiency of $150. Now, here again, there's another mitigation provision. If the reduction in salary or wages was due to you having to cut the wage rate during the period February 15th through April 26th, if you restore the wages, the wage rate by June 30th, you won't be penalized for business tax. And here again, there's a question whether you have to restore the wages of all of the employees whose pay rate was cut to qualify for the mitigation provision, which the statute seems to suggest, or whether you would get the benefit if you just do it for some of them. In terms of your question, we should probably talk about just first background, the economic injury disaster loan. So the economic injury disaster loan is the loan that you obtain directly through the Small Business Administration. Georgia has been declared an economic disaster area. And this loan, the amount of the loan can be as much as $2 million. Also, this loan can be used for wider purposes than the paycheck loan. It can be used, for example, for any working capital needs. For example, to pay vendors, accounts payable, principal that's due on loans, which are not permitted purposes for the other loan. The other thing about this economic injury disaster loan is, again, there's a very simple online application that was just introduced last night on the Small Business Administration website for this loan. If you apply for this loan, within 3 days, they indicate And furthermore, if it turns out that you're not approved for the loan, you do not have to repay the $10,000. This loan is also different.
Robert, I think we're starting to have some technical difficulties with you, with your speakers on your computer. Is there a possibility of you using headphones by any chance?
So
Perhaps I'll turn it over to Louann.
Travis, can you hear me okay? I'll jump in.
Yes, I can hear you okay. And I also want to bring up a couple of points. The Economic Disaster Injury Loan is a direct loan coming from SBA.
That's correct.
The Payment Protection Program loan is being funded through lenders that are participating in the 7A program.
That's right.
Okay, perfect. So the Economic Disaster Injury Loan, that application has gotten a lot simpler since last night.
That's
And
right.
this is the particular program that will allow you a $10,000 advance. Is that what that is?
Yes, so the benefit here, and yeah, this assumes that both can be applied for. I think that is open to hot debate, and reasonable minds out here are differing. But let's say, assume you can apply for both. It's an online process with uploading forms. This one got going, it's been simplified since then, but it got going around mid-March. So I guess presumably the SBA, there's more familiarity already with it, I would say. And they've worked out some of the kinks, like website crashing when it first became available.
Gotcha.
UGA Small Business Center, my contacts there seem very well versed in the EIDL loan.
Okay.
So in new normal time, it's been around longer.
So I have a question for you. Can someone with a side business, with or without employees, apply for either of these, even if they are still working a job?
So my guess here would be yes, but for the PPP loan, you would be required to wait until April 10th. I mean, I think in that capacity, you are an independent contractor or a self-employed person, I guess, or a sole proprietor. I guess
Right.
you fall into one of those categories. So let me be brief for a bit. I'll switch back to some other features of the EIDL. I think the other one, and I don't mean these in bad ways, but the PPP loan, I think people heard about that, and it's correct. It is, in a sense, free money. By using the formula Rob gave, it, I think, very well easily be spent in 8 weeks on payroll and rent and utilities. So the entire amount that you get probably will be. The EIDL loan, there's a $10,000 advance. It's made within days after submitting the application. So it's quick money in the short term. The $10,000 will be given even if you're not approved for the loan. There are some other features, as Rob mentioned, you know, maybe if you need the money longer term or for some different purposes, the maximum term is up to 30 years at the discretion of the SDA as advisor. They're not underwriters. It's up to $2 million, but really the intent is to give a projection of what's needed for the next few months of short term. So if you apply.
I'm so sorry, Leanne. So to talk about the Economic Disaster Injury Loan, if I apply for it, I'm advanced 10,000.
Right.
If I'm not ultimately approved through whatever the criteria and the process that SBAs go through, because this is a SBA direct loan, I'm not obligated to pay the advance back.
That's right. Even if the loan is ultimately denied.
Even if the loan ultimately. So can this loan be used to purchase property? So let's just say, for instance, during this time, my rent is $1,000, but I really don't want to lay anyone off, or I want to be able to kind of shore up some cash flow. So it'll be easier for me to purchase the building and have a $200 loan to pay back, or maybe even a forgivable loan. So am I able to use this loan to purchase property?
No, it's the intent is for, same as the other one, really, for short-term working capital needs. So it's a little broader than the PPP because you can use it to pay principal on mortgage. The PPP, you can only use it to pay the interest on mortgage. Both types should pay your building rent. The economic entry loan, you can use it to pay other accounts payable, other debts of the business. I would call as assumed in the ordinary course, but it's not to give, I guess, what might be an advantage to refinance existing debt or properties. It really is also designed to get over the hump and short-term working capital.
So what if I started my business January this year? We were running, we hired 5 to 10 people, and this happened. Because I started my business this year, would I still be able to qualify for either the PPP or the EDIL?
Yes, the time in business has been waived. Sorry, that's one of the requirements. That's one of the ways the CARES Act relaxes standards. There's no particular amount of time in business. And to finish off the comparison between the two types, for the economic entry loan, no prepayment fee, no fee to apply or loan cost. Payments are deferred for the first 12 months. I don't think we mentioned that on the PPP, but to the extent the loan's not forgiven, payments are deferred for 6 months. The interest rate is still favorable, but will be a bit higher for the economic entry loan. It's 3.75%, 2.75% if you're a nonprofit. Maximum loan term is 30 years. You potentially have something longer than what's set at 2 years for the PPP. And no federal will be taken if it's available. I asked the SBA, UGA contact for an interpretation there, and they're still struggling through that. It's like, okay, with what if it's real property? They said, if we don't care if we're second or fourth, fifth, sixth position, we want to take a security interest in it. So
wow. So
how we get filings made, and
okay.
But it's also been increased. Personal guarantees of 20% and more owners are required if the loan is above $200,000. I think it used to be required in all cases, or much lower, maybe $20,000 loan. So that's a significant change there. I think the biggest tension is, can you really get both? And what if I'm allowed to have both? I mean, the parameters are about the same for applying, but if you're not really allowed to have both, which does the business think would suit them better, to try to go for the loan forgiveness or try to go for something that maybe they can get a higher dollar amount for a longer period of time?
So the higher dollar amount for a longer period of time, that would be the PPP.
No, flipped.
I'm sorry. Yes.
Straight up formula, the 2.5 times, and it's calculated a certain way, but shorthand 2.5 times average payroll, monthly payroll.
All right.
Potential and maybe likelihood for most small businesses to be fully forgiven, because it will probably be used up in 8 weeks.
So we've talked about two programs. We've talked about the PPP, which is the payroll protection. We've talked about the economic disaster injury loan. Is there a third option for us?
I guess I'm seriously hoping Rob is still here. His face pop up a lot of the time because it is tax driven and it is a tax credit.
It's a tax credit and tax driven. Okay.
Hopefully, does my sound system work a little better? Can you hear me?
It's a little better.
A little better. So the third program is the employer retention credit. Now, it is not available if you take the paycheck loan. The employer retention credit could be as much as $5,000 per employee. And a business would qualify in the quarter in which either its operations were shut down by government order and continuing through a quarter while shut down, or a quarter in which its revenue has declined by more than 50% versus the prior year quarter, and continuing through until its revenue recovers to 80%.
So the employer retention tax credit is a tax credit that is going to give us a $5,000 credit per employee. And we can only get that credit if we do not have the payroll protection loan. Is that right?
That's correct. You cannot have both of them. And the credit is 50% of, it's calculated as 50% of the wages and medical expenses for the employee during the periods I mentioned. Now, there is a difference between employers who had more than 100 full-time employees on average in 2019 and those who had less. For those who had less, the credit applies during these periods for both the employees that they're paying who are working, and if they are paying employees who can't work because of COVID-19. For employers who are above 100, the credit only applies for the employees that they are paying during this period who can't work because of COVID-19.
So I got a question. What if a person has filed personally bankruptcy, but not the business? Could they still apply?
Well, that's a great question. And, I think on the application program, the applications that were introduced for the PPL and for the EIDL, in the case of the EIDL, I think they did ask about sort of bankruptcy of the owners, because they do sort of consider your credit and the credit of the owners in the case of that loan. But in terms of the paycheck protection loan, the application doesn't seem to be asking that question. So
Gotcha.
perhaps that leads you to believe that that is not a prohibition.
So for the sake of time, we have about 8 minutes left for this particular phone call. And so for anyone that's on the phone call, I want you to know that we were able to send out an email and have a series of questions that we're currently asking to our guests today. We will have these questions published with the answers to them if we do not make it through all of the questions. And so I just want everyone to know who's on the call. And if there was someone on the call that left and you know that person, please let them know that they will have the ability to know what these questions are and have these answers and also have accessibility to these two individuals and other individuals that are within our community that can help you through the process. If I'm an equity owner and receive a W-2, do I qualify? And what makes me ineligible?
So that's a great question. So definition of payroll includes wages paid to employees or for self-employed individuals for self-employment income. So if you own a business that is structured or is treated like a corporation for tax purposes, such as an S corporation, or if you have a professional corporation or a liability company that you've elected to be treated as a corporation, your wages as an owner are reported on a W-2. So they would count for payroll for purposes of determining the amount of the loan and the permitted uses of the loan.
So even if that amount is part-time pay, would that?
Yes, it's the pay of any employee. Now, if you are structured as a tax partnership, the payments as an owner that you're receiving for services technically are not, for tax purposes, treated as payments to an employee. They're treated as a guaranteed payment, and they're reported on Schedule K1 rather than a W-2. It seems that those type of payments don't qualify as payroll for this purpose. However, it's possible that the SBA could come out with guidance clarifying things and saying that they do qualify.
Perfect. My last question before we leave here today is, can I refinance my injury loan into a PPP loan for a higher forgivable amount?
So the PPP statute clearly allows you to refinance an economic injury disaster loan into the balance of a paycheck loan if you do so by June 30th, which is the ending date for applications for paycheck loans. And this sort of gets to your question about whether you can apply for both loans. We have seen different people come to different views on this, or whether you can obtain both loans. Based on the structure of the statute, I tend to, and also based upon some comments of Senator Rubio, who was the main sponsor of this bill as chairman of the Small Business Administration, I think that they do contemplate the possibility of obtaining loans under both programs. But I have to say that other people have come to a different view, and that is an area where we really do need some clarification.
Perfect. So I want to say this in our closing is, Mr. McGuirk, Ms. Bronstein, you guys are awesome, and thank you for being in our community and being accessible for all of our questions. We are in the middle of something that I don't think that any of us would ever expected. And once again, I would like to say thank you to the Chamber. I would like to say thank you to the Downtown Development Authority here in Brunswick, the Development Authority for the County of Glenn. If there's anyone else that I missed out on thanking, please blame it on the mind and not the heart. And also individuals that are still on the call, know anyone that's on the call, and I think I made mention to this in the beginning, you will get a copy of the recording that was here today. You will get a copy of the questions with answers, and you will get a copy of a very, very, very easy to read chart that HunterMaclean was very nice enough to provide to us. It's very easy to read. And last but not least, our partners with the University of Georgia, SBDC, the Small Business Development Centers that are here in Brunswick, has also asked us to let everyone know, please do not be afraid of these applications. Please, please, please do not be afraid of these applications. Come to them. They will provide all the technical assistance that is needed to get you through this time and get you through this application. I'm 100% positive if you come to myself, Matthew Hill at the Development Authority, the Downtown Development Authority, Ryan Moore at the County Development Authority, or Ralph over at the Chamber, any of us will be more than happy to help you. So with that said, I want to say thank you guys for showing up today, and thank you again, Ms. Bronstein and Mr. McGuirk.
Thank you. Hopefully we were of help.
Thank you guys. Have a wonderful day.
Thank you.